The third method to manage liquidity was through the Fed's funds market, which is nothing but domestic interbank borrowing and lending of deposits at the Fed. Interbank borrowing and lending takes place through either correspondent banks called correspondent Fed funds or the interbank market, also called the brokered Fed funds. So before we understand the Fed funds market, let's look at what correspondent banking is. The correspondent relationship between banks was a result of more regulations imposed on banks. To understand these regulations, we need to go back in history of the banking system in the US. Early banks were incorporated by either the state or the federal charter. The banks incorporated under the federal charter, called nationalized banks, were given permission to open branches nationwide. The first and second banks were dominant banks with nationwide branches, giving them advantages over other banks in payments and deposit mobilizations. The first bank was also a banker to the federal government. The expansion of state banks were, however, restricted by their charters by strictly prohibiting the banks from conducting business outside the incorporating state, prohibiting branches across state lines, not allowing banks to engage in securities, and other restrictions limited the scope and scale of banks to increase profitability. In order to facilitate payments, a bank in one city would form a relationship with a bank in another city. Now, these relationships are called correspondent banking relationships, and the banks involved are called correspondent banks. Besides facilitating payments, a correspondent bank might also facilitate credit extensions or trading. Since each bank had a competitive advantage in the region it operated, this correspondent relationship worked out quite well. The correspondent bank would set up credit limits, policies, and procedures to deal with the respondent banks, which are basically the smaller local banks. While the small country banks, which are the respondent banks, were specialized in mobilizing deposits, they would need the services of the larger banks to extend credit. These country banks, which were surplus with funds, would keep their balances with correspondent banks. So the comparative advantage of a respondent bank or a country bank would be to mobilize deposits, whereas the comparative advantage of a correspondent bank, the large bank, which are the city bank, would be to have access to the credit markets. Now that we have a clear understanding of what correspondent banking is, let's understand what the Fed funds market is. We will begin by understanding what correspondent Fed funds are first. The Fed funds market is a market in which banks lend to one another their deposits at the Federal Reserve Bank, the excess deposits at the Federal Reserve Bank. This transaction is done daily and is quite simple to understand. Let's take two banks. One is called Small Bank and has a $10 million deposit with Large Bank, the correspondent bank. Small Bank would be the respondent bank. Small Bank withdraws its deposit with Large Bank and then sells the $10 million funds to Large Bank in the form of Federal Reserve funds or Fed funds. Large Bank's entries would be to reduce its liabilities with Small Banks by $10 million and purchase Fed funds by Small Bank. So the journal entries would be, for Small Bank, their assets, which is the deposits placed at Large Bank, would reduce by $10 million, and their lending to Large Bank, which is Fed funds sold to Large Bank, would be plus $10 million. Liabilities and equity of Small Bank would be unchanged. For Large Bank, the deposits, the liabilities to Small Bank would reduce by $10 million, and the borrowing, which is Fed funds purchased, would increase by $10 million. Now, in the case of correspondent Fed funds, no Fed funds are actually bought or sold. It's simply a transfer from one account to another account at the Fed by the two banks. The federal funds purchased is a borrowing of Fed funds, and the federal funds sold is a lending of Fed funds. Now these terms continue due to historic reasons, but at the end of the day, it's just borrowing and lending of Federal Reserve funds. So this agreement now allows large bank to pay interest on borrowings based on the federal funds rate. Since it is a borrowing, no reserves or deposit insurance is required. The participants in the Fed funds market are those that can place deposits at the Federal Reserve banks, such as banks, government securities dealers, thrifts, etc. Now, hundreds of US banks participate in the federal funds market, including foreign banks. Banks having excess reserves lend to banks with deficit reserves, generally on an overnight basis or sometimes on a term basis. Transfers are done via FedWire. Now these are unsecured loans made at the federal funds rate, which is the average rate at which these transactions occur. The Federal Reserve Bank uses the Fed funds rate as a tool to implement its monetary policy that we shall look at in more depth. The Federal Reserve Bank sets a target range for the Fed funds rate depending on economic and monetary conditions. A measure of the Fed funds rate is the overnight or daily Fed funds effective rate, called the FFER, and is calculated by the New York Fed, provided by data from Fed fund brokers. The interest on reserves, or the IOR, is the rate depository institutions or other eligible institutions earn on their reserves at the Fed. The components of IOR, or interest on reserves, are interest on required reserves and the interest on excess reserves, the IOER. The IOER rate effectively provides a floor for the Fed funds rate, since banks could keep the balances at the Fed rather than lending it to one another. This provides the Federal Reserve some control over the FFER, or the Fed funds effective rate. Banks can arrange for Fed funds directly or through Fed funds brokers. Now these brokers that broker funds like government security brokers submit the aggregate data on transactions to the New York Fed. Volumes done in the Fed funds market range anywhere between 70 billion to 120 billion. Now we've mentioned that the majority of the transactions are routed via the FedWire fund services. The FedWire is a communications network that links financial institutions to the Fed, to the Federal Reserve Bank, used to transfer Fed deposits between themselves. The lending institution authorizes its district federal bank to debit its reserve account and credit the reserve account of the borrowing institution. Most of the transactions are regular return transactions, which are overnight transactions, so returned within 24-hour borrowings. There are also early return transactions where the funds must be returned at a specific time before 24 hours. Now these early return transactions would trade a few basis points lower than the overnight rate. So understand the Fed funds market completely and in depth, so when we revisit this in the Federal Reserve's monetary policy, we should have a clear understanding of how the Federal Reserve Bank can control the federal funds market.